Afternoon, good evening, or good morning, wherever you are. I'm Dave Marchick, and I'm the interim president of American University. Thrilled to have all of you. We have over 900 people registered. Some will be on this channel, some will be watching on YouTube. So thrilled to have you. This is our third book event of the summer. Our fourth is August 3rd, where we have David Rubenstein, who is the co-founder of the Carlyle Group and also the principal owner of the Baltimore Orioles, has a new book coming out about sports ownership, and interviewing him will be Yankees legend Alex Rodriguez and Bloomberg's Jason Kelly, who has a podcast on the business of sports. So you can sign up online at the AU website or the Kogod website. We're thrilled to have two amazing talents for today. First, Andrew Ross Sorkin. We're going to focus on his latest book, but he is a New York Times columnist. He founded DealBook, which is really the state-of-the-art newsletter in the industry. He has written books like Too Big to Fail, which became a movie. He co-produced Billions. He's co-host of Squawk Box in the morning on CNBC. He's basically done everything, and I'm trying to find a fault or two, but have not found it yet. And interviewing him is someone who's been a friend of mine for 34, 35 years, Tom Nides, who is currently vice chairman of Blackstone. Tom is one of the most talented people I've ever met or worked with in my life. We worked in the early days of the Clinton administration together. Tom has been at Fannie Mae. He's been chief operating officer at Morgan Stanley. He was a senior leader at Credit Suisse, and he also has served in the top levels of the U.S. government. He was Deputy Secretary of State and also Ambassador to Israel, and he graciously agreed to interview Andrew at the Blackstone headquarters in a beautiful studio. So Tom, Andrew, thank you for being here. Tom's going to interview Andrew for about 40 minutes. And then I will take questions from the audience and ask them to Andrew. Maybe we'll throw in one for Tom as well. If you have a question, just type it into the Q&A function in the chat, and we'll get to as many questions as possible. So over to you, Ambassador Nides.
Thanks, David. Thanks to Andrew. I want to first say, listen, I never thought in my world that I would be calling him Mr. President. That would be Marchick, okay? Right. So the reality that he has achieved such greatness is quite exciting for me, and I know he'll take the university to a great length. So, David, thank you for having me. Andrew, thank you.
Thank you, and I should say thank Dave as well. I had the great privilege of being a commencement speaker.
Wow,
this year,
big time.
Under Dave's leadership here, right before he got the big job.
Listen, I think it's we're all big fans of Marchick, so congratulations to him. And listen, as you know, Andrew and I have been friends for a long time. You are, as what journalists call, a real journalist.
Well, thank you. And you were, by the way, also, we didn't say, a character in Too Big to Fail.
Yeah. Okay.
Okay. Real life character.
Yeah. That was fun. Yeah. It gives me shakes just remembering that. So let's get into this, because I think what I really want to know from you is, did you write this book principally to tell the story of the Great Depression or to scare people about what might be happening in the future?
So the truth is, I wrote this literally to better understand what happened in 1929. It was not, when I first began this project, I wasn't even thinking about today. I knew that we all are always looking for sort of pattern recognition and trying to see, are there things in the past that relate to the present? For sure. I always thought about that. But, I think for most Americans, we all have a sort of notion that something very bad happened in 1929. Oftentimes, people think 1929 equals the Great Depression, which actually does not when you really get under the story. And I thought that the characters, the people behind what had happened had been sort of lost to history. There's some great books about this period of time. But for whatever reason, they were written by economists and other things, and people weren't focused. Those authors were never really focused on the individuals at the center of it. And given what I wrote in 2008 about the financial crisis, I realized that, we often talk about economic cycles and systems and big institutions, but to me, it's ultimately people who make decisions that create those economic cycles, that make those decisions. And if you can understand them, you can understand not just a period, but maybe that's the pattern recognition, which is you can understand yourself.
So talk about this guy, Tom Lamont. And,
Yes.
It's interesting. He's clearly a big character in your book. And just for the people who are listening, his great grandson is the current governor of Connecticut. Who says nepotism or the once you're born on home plate, it continues on. But talk to me about Thomas Lamont. And I was reading the book, and you're digging through the Baker Library, right?
Yep.
And you see transcripts of conversations between Lamont and Hoover.
And Hoover and also Roosevelt.
I didn't see. Yeah.
It was shocking. He was, by the way, CEOs back then were spending as much time in the Oval as CEOs as they do today.
Exactly.
And that was not something that was on my bingo card in terms of thinking about what was happening then. But no, Thomas Lamont was really the entry point for me into this project. I was at Baker Library, happened to be there one afternoon and started going through boxes just to see what was out there or available. And I was shocked to sort of see these letters and diaries and notes that really put you with him in these remarkable moments.
Tell people who Lamont was.
Thomas Lamont effectively ran J.P. Morgan.
Yeah.
Jack Morgan was the son of J.P. Morgan, and he technically was the CEO. But Thomas Lamont ran it on a day-to-day basis. And he was somebody who spoke to every CEO in the world, presidents, obviously Hoover and Roosevelt. He spent time with Mussolini. He spent time with Hitler. I mean, this was sort of the consummate consigliere to modern America, if not sort of the corporate world. And he was really at the center of it. And in fact, early on in the book, in 1929, he is sent to Germany, or rather, I should say to France, to renegotiate the deal the U.S. had made with German reparations, which is fascinating too, because all of the big CEOs were being sent to go do this effectively to become our diplomats. It also reminded me of, the recent meeting that President Trump had with President Xi Jinping.
With all the CEOs.
With all the CEOs. And this was a very sort of different time. And really, finance had almost eclipsed politics at that point.
And was Lamont a good guy or a bad guy?
It's a complicated guy. I would say he was generally a good guy. I don't think that he, unlike some of the others who made some really terrible mistakes or was a true cheerleader at every turn, I don't think that Lamont was that. But he was somebody who was obviously, he was a pusher. He was a pusher. And early on in the book, as you know, and this gets to sort of a great moral question, he was somebody who not only had these relationships, but one of the reasons he had these relationships was he was paying for the relationships. He was gifting people shares of stock at lower prices than the public was being offered. He was sort of a behind-the-scenes player, making things happen.
Reminds me of 2008 or 2001. So talk to me a little about his relationship with Hoover, because I found the transcripts you talk about quite interesting. Was Hoover scared of Lamont? Did Lamont think that Hoover was dumb? How do you read this stuff?
Great question. My feeling or my thought was that Hoover, Lamont had this almost magical ability to make people think he was important. And there was a little bit of a power by virtue of proximity. Because he was in touch with Hitler and in touch with Mussolini and in touch with every CEO, if you were Hoover, you thought, you know what, this guy is networked up. I should be talking to him because he knows stuff. He knows what's going on, and he can give me the sort of the feel for what's happening. I don't think Lamont thought uniquely highly of Hoover. And frankly, I don't think Hoover necessarily thought uniquely highly of Lamont. But I think it was a relationship where Hoover thought maybe I can get some information from this guy that's somehow valuable. And of course, Lamont always thought that he could influence Hoover, and frankly, often could not.
Do you think when history looks back, Hoover gets a bad rap?
Yep.
Obviously, he's considered one of the worst presidents in modern time. Did he deserve the rap? Did he screw things up?
I am more empathetic about Hoover than many other authors.
Yeah.
Largely because if you really think about the timeline of the crash of 1929, you know, he gets in office in March, and back then the inauguration was actually later.
Yeah, tell people that, because that's an interesting day. People forgot that.
The inauguration took place in the first week of March, as opposed to in January, and so
that was significant, that period of time.
That becomes significant later on,
yes.
Especially when the transition between Hoover and Roosevelt happens, because there's this sort of very lengthy period between when you get elected and you become the president, and that period, and now we're talking about 1932, becomes significant and very important in 1932, 1933, because during the period when Roosevelt wins, there's a whole bunch of things that probably should have happened to save the economy that Hoover felt he could not do without Roosevelt's help, and Roosevelt had no interest in helping him.
And do you think there was, as you dig into this, do you think there's one single thing that Hoover could have done that could have stopped what ultimately was the most significant economic disasters? Maybe even probably certainly worse than 2008, but we'll talk about the comparison between the two. Was there something he could have done?
I don't think it's a single thing. I think it's multiple things. But I think the lesson for me about 1929 and then the Great Depression is it's really a series of dominoes. It was not preordained that when the first domino went down, that all the other dominoes had to go down too. So the first piece is he gets in office in March. The crash happens in October. If he had really taken this truly seriously and decided, at the time, that summer, for example, Carter Glass, the senator from Virginia, who was really the sort of AOC or Elizabeth Warren of his time, was talking about creating a trading tax. Had you actually implemented a trading tax, it is possible you would have slowed down the sort of speculative bubble. There are probably other things that he could have done ahead of October. The reason I have empathy for him is he gets in office, it's not that much time to really figure out what to do. But then he makes a whole series of other mistakes along the way. So the crash happens. Then there's a big conversation about raising taxes, but probably the worst idea in the middle of all of this. Then he decides, well, he's going to put the Smoot Hawley tariffs into play. This is now 1930. And he does that in large part because back in 1928, when he was running around the United States, desperate to get people to vote for him, we needed farmers to vote for him. And he pledged to them, look, you vote for me, I'm going to put some tariffs on to help your business, and felt that he needed to make good on his pledge. Well, that was a horrific decision. Had he not gone through with that, I don't know where we would have been. And then there was sort of two ideological issues. One was, his Treasury Secretary was Andrew Mellon, who I do not think was a good influence on him, in part because Andrew was a true capitalist with his C and thought, you know what, if you make a lot of money, good for you. If you lose a lot of money, I'm sad for you, but, good luck. And I think that permeated some of the early decision-making. Also sort of misdiagnosis of the problem early on, where there was a view specifically by Hoover that somehow he could jawbone his way out of it. The market was somehow separate from the economy. The other thing people forget, and this, I don't know if you knew this, the market by the end of 1929 was actually only down 17%. And so if you had closed your eyes and just looked at a chart, you would have thought, not so bad. But what had happened was people had, effectively traded with so much leverage, so much debt. You could go, actually down here, we're on Park Avenue, on Park Avenue, you could go to a brokerage house, literally on this street, and you'd put a dollar down, and the bank would lend you $10.
Yeah, a lot of leverage.
So that's why when it fell 50%, it wasn't that you could get back to 17% because you couldn't hold on. The bank had already called and taken your home. And so I think there was sort of a misdiagnosis early on about what was happening. And then the last piece was, I think, Hoover. It was interesting. Both Hoover and Roosevelt didn't want to save banks, didn't want to implement things like FDIC insurance, which didn't exist at the time, or anything like that. And so when the banks started to have trouble, and this now starts really in earnest in end of 31, 32, there was such a pushback, sort of an aversion to let's try to protect these banks because of the moral hazard issue. Again, a mistake that was made then. By the way, that became a debate all over again in 2008.
Well, it's giving me shivers because obviously, we all the things you've been talking about obviously played out in 2008. But before I jump to 2008, what was the characteristics of 29 and 2008 that were the same, and what was substantially different? And one of the things in the back of my mind, I hear Bernanke talking about the lessons because he was a student of the Great Depression and the big bazooka of we got to do everything we can.
Right. So
tell me, like, I know everyone asks you the same questions, but but it's interesting because you study both of them so much. Right. Comparison and contrast the two.
So look, the biggest thing that was happening in the 20s was, and it's actually probably more similar to now than it is even to 2008, was just the remarkable amount of euphoria and excitement around technology. And that excitement had real basis. I mean, this was automobiles for the first time, really changing society. This was the idea of radio. RCA was the NVIDIA of its time. Everybody wanted to buy RCA. RCA also owned the patent for television. And so these things, they did change the world, but people bid them up in sort of remarkable ways. So the similarities, I think, were, back in 2001 or late 90s, again, or even in 2008, there was sort of this remarkable sense that, like, the world was changing all over again. So that was probably the biggest similarity. The biggest difference, of course, and you said it, Ben Bernanke did his PhD thesis at Princeton on the Great Depression, and he learned the lesson when you have a crisis is, as politically unpalatable as it may very well be, you have to almost throw money at the problem. The natural instinct is to pull back, but you actually have to do the opposite. And so, here we were in 1930, 31, 32, and there really was a pullback and a sort of almost pullback to austerity, as opposed to Keynesian sort of let's put all the chips on the table. And I think that's what we've learned. We've learned that, unfortunately, you have to write the check. Now, that worked in 2008. By the way, that worked again during COVID. My new fear, by the way, is that we've now learned that the playbook is write the check. By the way, back in where I was going to go is we have $40 trillion of debt today. Back then, I think we had a budget surplus, just to give you a sense of what was happening. So the next time when we write the check, maybe we'll tip over, but I hope not.
Yeah, I hope that too. It's funny. When I was reading the book, I don't know, you talked about this in the Too Big to Fail. There's a chapter that obviously I was somewhat engaged in, but one of the things I was involved in behind the scenes was trying to get to stop short sellers. Mm-hmm. Okay. And I convinced John Mack at the time to call Paulson and to say, we got to stop, because we were getting crushed. They were shorting our stock. They were shorting our bonds. It was a nightmare. Okay. Yep. And our stock was dropping like a rock, and obviously the fear factor. So I said to John, call Paulson, see if he can stop the short sellers. Well, one thing led to another, and Hank actually did that. Mm-hmm. And I thought, well, that's a genius. So I read in the book that Senator Glass wanted to do the same thing. Now I shouldn't say it, but Druckenmiller, who was our big client, stopped doing business with us because he was so pissed. Pardon me, he was so angry that we had stopped the short sellers, because clearly he got caught in the squeeze when we stopped the short sellers. Was that a bad thing to do? Would you have advised people to do what was going on? Because you were obviously reporting on it at the time.
Well, so banks are an unusual business because they really are based in large part on confidence. You have to believe that the money is there, that they're going to be in business. That's a huge component part of the whole ecosystem working. And so when you have these sort of mechanisms in place where people can try to undermine that confidence, it's funny because I have very mixed views of this. I think back to David Einhorn blowing the whistle on the Lehman Brothers, frankly. And you could probably argue that was a good thing for him to have identified some of the economics at that business that were troubled and that I don't think the public appreciated. So there's part of me that as a journalist, by the way, I oftentimes look at short sellers and think to myself, yes, they're incentivized for things to go down, but they're also incentivized to try to find problems. And by the way, most other investors are incentivized not to find any problems. So maybe it acts as some kind of check on the market. The conundrum in the banking business is that check on the market can become its own self-fulfilling prophecy in a very bad way. And so how do you manage that?
And when you step back and you look at the actions,
right,
that Paulson and Bernanke and Geithner were making at the time, and you compare those to the actions that Hoover and then obviously Roosevelt but what actions, if you could do a crystal ball again, that they took in 2008, would you say they had taken those same actions, including flooding the zone with a lot of cash? Are there any other kind of banking things you would have done back then if you knew?
Oh, for sure. I mean, I mentioned the tariffs thing. No, you would have gone and if you could have implemented FDIC insurance, for example, earlier, that would have been a huge sea change. I mean, the other big problem, this is now once we get to 1930, the reason, you had people lining up around the bank because people were losing all of their money because a bad rumor would go around about a bank and then everybody would rush to get their money out. And if you didn't get your money out first, you were left with nothing, like literally nothing. And there was nobody to call and say, hey, you still owe me the money. The money didn't exist. So there were lots of things they could have done. They could have rescued banks. They could have put more money into the banks. I mean, there were so many things. And by the way, a lot of those things Ben Bernanke and Hank Paulson were doing in this period of 2008. And I think a lot of that came from some of the lessons learned during that period.
Well, it's funny. Again, one of the scenes in your book, and I think I probably gave you the scene because I was there, and it kind of harkens back to how much power Hoover had and didn't exert. As you recall, in one of the scenes in your book was the night that we were sitting in John Mack's office, and his assistant walked in and said, "John, the following people are on the phone: Ben Bernanke, Hank Paulson, and Tim Geithner."
Right.
And to be clear, as a CEO of a bank, you do not want those three people on the phone call. They got him on the phone. John got him on the phone. He put him on the speakerphone, and Hank Paulson said, "John, I want you to pick up the phone and call Jamie Dimon and sell Morgan Stanley for $1 to JP Morgan." And John, at that point, we're all sitting there saying, "Do it," because at this point, we're going to have nothing left. And he said at the point, "No, I'm not going to do it." Now, the question is, was Hoover as tough on the banks as Paulson and Bernanke were in 2008? Because it didn't seem that way. It just seemed like the bankers were calling the shots, not the...
Right. No, so I don't think that the big distinction was there was no meaningful effort taking place to try to either merge banks or take really even any kind of control of what was happening in the banking system. The biggest thing that Hoover was trying to do, but it was too late, really was he had now lost the election. And now we're into 1932. He's lost the election. Roosevelt is going to be the incoming president, but won't be now for many months. He's seeing, to his credit, that the banking system is now really off the rails and needs to be saved effectively, and that there needs to be a backstop. They need to probably put some kind of insurance program. They need to do some things that would really buttress the banking system, therefore the rest of the economy. And of course, it then but thinks to himself, you know what? If I try to put some things in place now to sort of create confidence, I don't know if it's really going to work, because everybody knows I'm a lame duck. I'm not going to be the president in a couple months from now. And Roosevelt might try to undo all this stuff. So I'm going to go to Roosevelt and say, hey, let's lock hands here. Say we're doing this together. Because if we say we're doing it together, then, of course, people might have real confidence, and it could prop these banks up and prop the rest of the system up. And of course, Roosevelt thinks to himself, well, if I hold hands with Hoover, if this doesn't work, and then I become the president, well, then I'm holding the bag for this guy's problem. So I'm just going to say, talk to the hand, and I'm not going to do any of this. And I'll do all the things. By the way, he was telling Hoover, I'm not going to do any of this, but he knew privately, I will do all the things that Hoover's saying to do the day after I become the president.
So when you think about this, and I was trying to kind of think about this logically about decisions, do you think, because I mean, when you're in these positions, as you've reported on 1,000 of them, you make split decisions quickly, right? And as you know, they during the 2008 they forced a lot of banks to merge. But the biggest decision I think they made was basically forcing Lehman Brothers to file for bankruptcy. if you've answered this question 1,000 times, in retrospect, was it a mistake to let Lehman go? And letting Lehman go, did that create even a bigger mistake?
Yes, 100%. Yes, I still, to my dying day, believe that letting Lehman Brothers fail was a mistake. It was not that it deserved to be saved, or that there was a particular, reason that made this some special institution that deserved it, but more so because that created the downward pressure on everybody else, and also sort of changed the rules in the middle of the game. And everybody thought, what is really happening here? Am I going down too? Are they really going to save it? So I think that was such a pivotal issue. Now, there are people who view this differently. So I don't want to say I like to play dominoes. I just told you 1929 was sort of dominoes. There are other people who say that 2008 was not dominoes, that it was really more like popcorn, that, one could go, the other couldn't. They'd all just pop however they went. I don't believe that. Having said that, I mean, look, AIG was sort of next in line, if you will, after Lehman. After AIG, all of a sudden the pressure was on your firm. It was on Goldman Sachs's firm. After that, all of a sudden you would have been living with, frankly, General Electric, which
they couldn't. Their bonds weren't clearing, so they had no cash. I mean, GE, American Express, anyone who was going to the bond market, they couldn't get any cash.
But I see those as dominoes, not popcorn. And so, yes, I do think not that you would have been able to completely stabilize the system had Lehman not gone under. I still think there would have been lots of things that would have needed to do, including, by the way, probably doing what they did, which ultimately helped Morgan Stanley and Goldman Sachs, which is to make them a bank holding company. Had they done that at the outset, had they done that Lehman weekend, I think the world would have been a very different place.
You don't remember this, but you were doing a lot of obviously reporting about, because Morgan Stanley was next. Okay, we were up to bat to go down, and obviously we got bailed out.
You see it as dominoes to our baseball.
100%. No, okay. It was completely the whole thing was falling apart, and we were clearly next. And as you know, we were struggling to come up with the money, right? Because Geithner was basically, "What's your plan? What's your plan B?" And I said, "Our plan A was to get bailed out by the Japanese." And he said, "The Japanese never do anything fast." And I said, "So what's your plan B?" And I said, "We have one." He says, "What is it?" I can't tell you right now. Of course, I didn't have a plan B. We didn't have a plan B. But the reality of this is, my view was simply that Paulson was never going to let Goldman go down. Right. And so our strategy was, we're going to be like the little dog on Goldman's pant leg. Right. And every time we talked about Morgan Stanley, we talked about Goldman Sachs. So he said, if they go, we go. And so our view was, certainly our strategy was, you're not going to take us both down.
And so by the way, that worked in a way.
100%.
Because that's
what we got that weekend, as we became bank holding companies. Right. And I remember that was the, and you guys did a lot of reporting that saved us.
Yes.
But they gave us some breathing room. Right. One of the things I think, and this is obviously the left and not left people who will say the commonalities of 1929 and 2008, no one got in trouble. Right. No one got in trouble. And do you think that's an accurate statement? And do you think people should have gotten in trouble? And who should have gotten in trouble if someone should get in trouble? So
it is true that in 1929, very few people got in trouble. The other main character of this book, 1929, is a guy named Charlie Mitchell, who I think is actually one of the most unique individuals.
And he ran Citibank, the equivalent of what Citibank is today.
Well, it was called National City back then. It was Citibank today. He lived up on 76th Street and 5th Avenue, right up here, and worked downtown. And Charlie did put the whole bank, frankly, on his back in a way, but then he made a very poor decision, which was really about taxes. This was actually, by the way, Al Capone had just been convicted. And he did this sort of swap with his wife of these shares, and ultimately, interestingly, was arrested, went to trial, and then was acquitted. And so
did he like sell shares as the stock was dropping to his wife to keep them out of his account? Is that what he was doing?
So what happened was he had bought a ton of shares of National City to try to prop things up when things were really at the bottom in October of 1929. And then he's thinking to himself, I have this, and this is now the next year he's thinking, I have this massive paper loss. And I would like to be able to use that paper loss to offset my taxes. But I don't really want to sell my shares because I'm the CEO of the company. People will know I sold the shares. So what I'm really going to do is sell them to my wife I'm going to lock in the loss,
sure,
and then she might sell them back to me later, or we'll figure that part out. And of course, this was known as a wash sale, which, by the way, back then was not illegal. The law changed. Lots of people were doing that, unfortunately. He was not the only one. He was acquitted because people felt that this was such a common practice, oddly enough, back then.
So go back to the 2008.
But to your bigger question of,
do people get punished?
Do people get punished? I don't think it's illegal to be stupid.
A lot of people would go to jail if that was the case.
So I think there was a lot of mistakes that were made, clearly. I don't think it was, and this is a very interesting issue just about white-collar crime, with intentional malice. People oftentimes talk about Dick Folds, who was the CEO of Lehman Brothers.
I had lunch with him last week.
Okay.
2 weeks ago.
And this is what I often think about Dick. I mean, I know people there have been people who've alleged and said, this was a crime that all of this happened. And I think to myself, this is a guy who had over $1 billion of stock in Lehman Brothers. And he rode his stock down to something like a couple $100,000, maybe less. What does that say about his intent? If he really, a criminal would say, the boat's going down, I got to get out of here, I'm selling my stock. He never did that. So I don't think, did he make some poor decisions? Yes, I do think he made some poor decisions. I think he would tell you he made some poor decisions along the way.
But it's interesting. That's a very good point, because I put what people think of what happened to Liam, but a lot of people got hurt. He got hurt, obviously, as bad as anyone did. No, he did not obviously go to jail, nor did anyone get prosecuted. But to be clear, his biggest mistake, he didn't sell the company, 6 months early. He believed in his own beliefs.
Yes.
And I think, I'm not defending Lehman Brothers, but when they broke the company up in the pieces, a lot of the pieces actually were paid back.
Had great value, yes.
Yeah, totally. So again, it's interesting because people always say the same thing, no one ever gets in trouble. And, and again, because history tends to repeat itself. Right. And maybe people just can't be prosecuted. Maybe it's not anything illegal, but you're right. Being stupid, if that's a crime, a lot of people maybe headed to that.
And that's why, look, maybe you think I'm too empathetic about it, but I generally don't think there was genuine criminality. Interestingly, I probably think there's less criminality at the top than maybe you could even describe. People talk about some of the mortgages that were made and people, putting fake signatures on things or things like that. That's a different game. And the question is whether you think people at the top knew that was happening lower down. I actually think one of the lessons of, by the way, all my reporting is that oftentimes the people at the top don't actually know what's happening 2 floors below them. I mean, they sort of have the big picture of what's happening, but they don't know the details. And it probably can't be expected to know the details. So, but that's my sort of broad.
So do you believe, you talk a lot about the regulatory framework that was put in place in 2008, right? Dodd-Frank, a lot of new rules that this should run too big to fail, all the things that were put in place. Some were controversial at the time. Do you think we're much safer today than we were in 2008? And certainly you believe we were safer than we were in 1929. Right. But could what happened in 29 happen again in the current regulatory framework?
I don't think what happened in 29 can happen again in the same way.
How about that 2008? Could that happen again today?
I think that's harder, but things are different. So to me, the single most important regulatory shift post 2008 was the massive improvement in capital requirements among the banking system. That to me, you could take Dodd-Frank and Glass-Steagall, all the things that almost beside the point. It was the capital requirements that changed everything. By the way, in 1929, there were no capital requirements, zero. In fact, no capital requirements even came into being. The Bank Act didn't even show up on the scene until 1940. So capital requirements to me were sort of the major shift that sort of changed everything. Now, the flip side is between Dodd-Frank and everything else that went on, the one thing that's now very different today didn't exist in 2008 really is the private credit market. So because of all this regulation, of course, capital loves to go where there's less regulation. The whole private credit universe gets created. And I think what we don't know about the private credit universe is just, I think it's probably a better system, but there's less disclosure about it. So it's harder to ascertain what's going on.
So, and obviously we'll take some questions from the audience in a second, but just a couple of things. When you go to bed at night, what do you worry about beyond writing another book? But
No, I don't worry about writing another book. I worry about what's happening in the Middle East. I worry about what's happening with the political climate. I worry about nuclear proliferation, which is in the news today. I worry, and then look, I worry about, from an economic perspective, I'm so excited about AI and artificial intelligence on one end. There's like, I can't tell you how excited I am about so much of what the technology could ultimately do, and the superpowers I hope it gives us all. But on one end, I worry that maybe the economics of this, what's propping up and levitating so much of the business world today, is going to falter, either because the math doesn't math in terms of the return on investment, or because new technology emerges that means that we don't need to build out data centers at the level we do, or because some new technology comes out that means we're going to do it all in space or whatever. That's on one end. That's the sort of negative view on one end. And then the flip end is, well, in great success, if these valuations are really what they're supposed to be, it means we have to create credible productivity. And does productivity at that level mean that we have to take out a lot of cost? And what does that cost? Are we the cost? And how does that really work? So it seems to me that there's a somewhat narrow landing field in the middle somewhere there to land the plane on, but that we could tip over on either end.
And if you were the president, and you said to yourself, I really like AI. AI, it's going to improve healthcare outcomes, environmental outcomes, and food production, and all the things that AI is going to do on the positive side. But you fear, if you're the president, around the job issue, the productivity that people, white collar jobs may be lost. What do you do about that? What is you're sitting here and you're the president? What do you do?
So I am not somebody who would say slow down the bus. I do think there's probably some regulatory things you'd want to do just so that things don't go completely off the rails. This is cybersecurity and other things like that. I think you probably want to start a conversation, though, about what the transition looks like, how you'd pay for that transition. Look, I'm not somebody who would say go. There are people who would say let's go tax tokens or tax data centers in a different way. But I think we might need at some point, to think about things like that in the future, if in fact we get to a place where we are having a challenged transition, and that everybody knows the deal in advance. Meaning, if you are successful, not look at you as if you're Sam Altman, but if you're Jensen Huang, and if everyone's going to be as successful as we think, and it's going to create this other problem, let's just be prepared. Let's agree up front that we're going to have to change some of the systems to figure out how we're going to deal with the transition. Having said that, and I call it a transition, I'm not a believer long term that we're all going to be out of work. I do believe that we are very inventive. Humanity's pretty inventive. We'll figure something out to do, hopefully. But I do think invariably there will be some kind of tough time.
But is that because it's interesting, because as you know, what's happened here, it's been let a thousand flowers bloom, right? And states now are beginning to regulate, and we need, again, it's easy for me to say, having been in both of these worlds, but this is a time where we need regulation.
Yes.
Right? There's going to need to be some regulation around this, just by the nature. You talk about national security. Obviously, spent a lot of time in national security. That's one element of it. Education, job loss, another element. There's an issue around something. I'm not suggesting a universal basic income, but you're going to have to do. You have to
be ready for it,
and you're going to have to figure that out.
Look, the biggest thing I would do, if we really wanted to handle this, is could you hold hands with President Xi Jinping and make a deal about how AI is going to be regulated on a global basis? Because I think the single reason why there's a let all the flowers bloom, let the bus go as fast as possible, is a view that if we don't let the bus go, that there's this Chinese bus that's going to zoom past us. That seems to be the sort of central animating idea behind why we have to go as fast as we're going.
Do you believe that? Because that is, I mean, there's lots of views around making sure the Chinese don't leap in front of us on AI. But do you, as a person who spends a lot of time thinking about this, do you believe that is a threat?
I think it's a genuine threat. And I think it's proven itself out even in the past week and a half with what's known as K3 or Kimi, which is this new model, which is
open source too,
open weight. And, it's interesting. I think Scott Galloway made an interesting comment a couple of weeks ago that if you really wanted to ruin the AI business in America or the AI ecosystem, China should just flood our system with open weight models that they don't have to be even as good, but just like one notch lower, and people would just use those, and that would break the economics of the ecosystem that we're building and all of this investment. I don't know if that's true or not, but I do think that we have to think about this in a sort of global way.
And how do you think about these companies in the public markets? You've seen obviously SpaceX fall back to some level of Earth.
Yep.
You're going to have Anthropic coming out next. You'll obviously have OpenAI. How do you think about this from a capital markets perspective, and how people should view these companies going into the market?
Well, I think I'm going to put SpaceX in a separate category because SpaceX is not, it's increasingly becoming an AI company. It's also obviously a satellite company. It's a launching company. The TAM of that is actually, I think, quite extraordinary. I mean, I do think that there's sort of an extraordinary thing there. And the other thing about Elon Musk is he has managed, even when he ends up making a mistake or going in the wrong direction, he then manages to pivot at the last minute and finds some other way out. Now, I can't promise he's always going to do that, but he does. I mean, even if you think about builds these data centers thinking originally he's building these data centers because he thinks it's going to be operating for XAI, and then realizes, well, XAI doesn't need all of the data. I'm going to now sell some of that space effectively to Anthropic. I mean, it's just...
there's no question about it.
There's something remarkable about that. Pure play Anthropic, pure play OpenAI, I think is going to ultimately be a larger question, just because you don't know how other technologies are going to emerge and whether all this gets commoditized. I mean, that's always been the big question. I've always thought the winner of this should actually be Google, because Google, A, they were the OGs. They figured this out before everybody else. B, they have more surface area than everybody else. They have your Gmail, they have your calendar, they're this, you're that, all the things, and they're all over your phone. By the way, they have 60% of the smartphone market through Androids. In the US, we think of Apple with everything. You'd think that they would, run away with it. And they haven't yet. Maybe they will. So I'm not sure where this.
I feel the next book is coming. That's why I think you're headed to your next book. So
AI.
I think you're a pro guy. So we're gonna do these questions, David.
We're gonna do the questions. Okay. Thank you, Tom. My first question, Andrew, is there a spot on Squawk Box for Tom? He did a pretty good job.
I thought he was awesome.
Yeah. Okay, David. Let's go.
I don't know. I will tell you.
How about David? Does David look like a college student right now? Just for record,
he looks like a college president. He looks like a college president. I think that I think Joe Kernan and Becky are going to be out on Friday.
Could be big.
So I don't know what you're doing Friday morning.
Could be big.
But we could use some help.
Huge. Go ahead, David.
All right. We have a series of questions around what might trigger the next financial crisis. Okay. And it's very hard to predict. But some of the audience are asking, will it be AI, the AI infrastructure companies, given their huge levels of debt? We have another question about, will it be crypto? We have another question about our national debt, and you see long bonds, above 5% for a long period of time now. So, Andrew, do you have a view on where the greatest risk is, and which one of these things, if any, might trigger the next crisis?
Okay, so I'll tick each one off as a no first. So the crypto, I think it's too small a part of the overall marketplace to create a demonstrable giant crash. I just think it's not big enough to do that. Could it impact parts of the market? Sure, and maybe we don't know how leveraged certain parts of that are, but I'm sort of less worried about crypto. It's not to say that I think crypto is great or good or bad. It's just I don't think that's the thing that's going to tip us over. I imagine if we tip over, and I'm not arguing we're going to tip over tomorrow. I think we have a couple of years, frankly, to run in terms of the massive investment that's going to continue in these data centers and the like. But I do think somewhere in there we could have a hiccup. And the question is it just a hiccup or does it turn into something else? What I worry about is waking up one morning and finding out that, either we'll hear some quarterly report where you find out that one of the big hyperscalers has actually pulled back materially in terms of what their build-out plans are, meaning they had told you that they were going to spend $100 billion, and all of a sudden they tell you that they're going to spend $50 billion. And I think people will go, well, what's that about? Are they getting out of the game? If they're getting out of the game, so I think you just need to watch. There could be some kind of thing there, or something where you have a company that's, building out data centers, but also doing it in concert with either banks or private equity or something else, and either they can't make the payment or something happens along the way, and that could become almost like a psychological break in the system. The thing I worry about, but I've worried about for as long as I can remember worrying, is about the national debt. I always thought there was a sort of invisible line in the debt market that would turn into a red line and that would tip us over to a point where the bondholders of the world would say, you know what, America, we like you guys, but you're not as good a credit as we thought you were. And we're very happy to loan you more money, but you're going to pay 2 or 3 times the interest rate that you used to pay. And for whatever reason, that hasn't happened. And so that's probably, to me, the scariest and biggest thing that could happen, because if that happened, talk about sort of 1929 sort of austerity pull, all of a sudden it changes the whole dynamic, the economics of the federal government, of employment, of everything. But that has not happened. And the argument is the world's relative. And as long as we seem to be the best place, and we got to remain the best place for capital and invention and entrepreneurship and all of that, maybe we can continue to sort of have this debt. I think to the extent that you start to worry that some other countries are able to outdo us, that dynamic could ultimately change.
We have a series of questions comparing the government inaction under Hoover with the government action under Bernanke, Paulson, Geithner, and also during the presidential transition. So a couple of weeks ago, I was with Josh Bolton, who was chief of staff to President Bush, and I remember telling him just how fortunate the country was that President Bush appointed Hank Paulson. And he said, you know how that happened? It was late in the term. People were tired. And I went to him and I said, do you feel like our team is the right team to manage a financial crisis? And Bush said, no. And he said, then let's get some new people. So I guess the question for you, Andrew, is, and maybe Tom, if you want to comment, if that were asked to the President of the United States today, what would the answer be?
Ooh, that's a great question.
I'll go no comment.
You're going to go no comment?
Yeah.
He's a diplomat.
I don't know and I'm not trying to be polite about it. I think Scott Bessent actually understands the markets in a very deep way. He's been in and around them for a very, very long time, worked with Stan Druckenmiller many years ago, also George Soros. I don't know if he has, I don't know enough about the whole team that he has around him. I also think, by the way, interestingly, Kevin Warsh has now a lot of experience because he's Kevin Warsh, our new Fed chair, but he had been the deputy to Ben Bernanke during 2008. And I think that he's somebody who's absorbed and learned a lot of lessons just from that period. So I don't think it's a bad team to have on the court, if you will.
I mean, you never know. Listen,
but you probably want to have a lot of other people around.
Yeah, and you never know. I mean, listen. The good news that the president has a lot of people in the business community that he talks to regularly, which is good, right? I mean, we can agree or disagree about who he's talking to get information, but he is reaching out. Right. He's on the phone constantly getting information, and he is very market sensitive.
Very market sensitive.
Okay, one would argue he's kind of an equity guy, not a fixed income guy. And that's probably okay, because at probably maybe slows down some of his knee-jerk reactions to things, or at least gets himself to reverse himself. At least he's a market reaction, which is good.
I think the market's actually been, people often say, the White House is Republican, the House is Republican, the Senate is Republican. Is there any governor on this system? The governor on the system thus far actually has been the market.
Totally.
And the president, I think, has been very cognizant of where the market is, probably more so, frankly, than lots of other presidents. To some extent, you might give him credit for that. If you got into a real bind, I think he would probably be trying to do all sorts of things to avoid that. Now, would he make mistakes along the way too? Maybe. It's hard to.
Let me twist the question a little, and for both of you. So you wrote a lot about, in both your books, about how financial institutions basically didn't handle either crisis well. 1929 or 2000, the too big to fail. So are financial institutions and their leadership better equipped today to manage a crisis than they were in 2008?
Well, this goes back to the capital requirements. By default, they should be. What I don't know, again, goes to maybe some of the private credit spaces or places that are sort of outside of some of the more regulated businesses. But, I think if you look, with the exception of Silicon Valley Bank, which went under a couple of years ago now, there haven't been that many real failures. I think we'd be in better shape. And I do think actually a lot of the people that managed those banks, with the exception of Jamie, actually, none of them actually managed the crisis, but a lot of them.
But they were involved, right?
Yeah, listen, I think the banks are fundamentally way stronger than they were. I think they have a better regulatory framework. They hired a lot of people. They had a lot more risk people. I think a lot more risk controls. Without question, the capital requirements Dodd-Frank made it better. Maybe we got too carried away. We aren't clear. Now Trump is now changing some of these capital requirements. But I think without question, the banks are way stronger than they were from a regulatory perspective than they were in 2008.
We have a question, Andrew. There's a fellow who was reading his book next to his 1-year-old boy.
Okay.
And he's read your quote in the beginning about Albert Einstein and questioning whether humanity has the capacity to teach their children.
Yep.
So why did you put that quote? The question is, why did you put that quote in there right around a dedication to your kids?
So the quote or the epitaph, what's the word? It's epitaph,
yeah,
they call it. Well, there's a couple things going on there. One was the quote is from Albert Einstein. I believe it was October 26, 1929. It was in the Saturday Evening Post. So it happened. That quote came literally as this was all happening, and it was this whole idea that can you teach your children anything, or do you actually have to live it? You have to have the lived experience to learn. And to the extent that I think all of us who read about history are sort of looking at pattern recognition, can we learn? And I think this was a little bit of my attempt to sort of suggest at the beginning of the book, here's my attempt to try to not outdo Albert Einstein, but my sort of effort to get there.
We have a question about AI companies from a Kogod alum who loved your speech. And by the way, your speech was one of the best graduation speeches. 9 minutes long. It's on YouTube. People should watch it. It is great.
You. Thank you. That's very, very nice.
And the question is, these new Chinese models that you talked about are so good, and they're open sourced.
Right.
You could have huge rapid switching. There's low cost to switch, essentially, unlike cable. So could you see a mass flight to some of the Chinese models, and could that trigger kind of a crisis with the huge amounts of debt?
That could ultimately be one of the problems. The interesting part, by the way, about a lot of the Chinese models right now, so the open weight piece of it makes it possible for you to actually run these things on your own servers and the like, and obviously takes down the initial cost, if you will, of building a model and training the model on the front end. They're actually, either as inefficient, in some cases more inefficient than most of the other than Anthropic or Claude or ChatGPT, in terms of the tokens it takes to answer a prompt. So when you put a prompt in, there's something that's called inference, and then it comes out with its answer. And that piece of it, you'll still need some big data centers to manage that if you're going to do that at scale. So while it upends parts of the economics of the business, it doesn't fully upend them yet. I also think, by the way, one of the things that I keep hearing about, and maybe you've heard the same from a lot of CEOs right now, who are using, the frontier models from Anthropic or OpenAI, sort of figure out processes, and then trying to replicate as much of that with much smaller, cheaper open weight models. So while they're using an Anthropic or a ChatGPT, the paid version, they're almost testing and playing with it and then trying to figure out how much of it they can sort of copy using these other cheaper models, and sort of how does that work long term. So I think there's a whole bunch of things going on at the same time. Are you hearing that?
Totally. Without question, because what's happened here is that these companies are at the beginning of this, right? And they understand the cost of this. This is not cheap. There's a reason why Anthropic is doing so well, right? The cost of this is significant. And so I think as they're beginning to see what models that can be used, they're also trying to figure out which models are the practical models, right? If they're the nice to have, there's the essential, and they're trying to stack their priorities and the cost based upon that.
I mean, the problem right now is it seems like, and I've even found myself doing this, I'll occasionally be using Fable, which is the most extensive version of Claude, which is like the Ferrari, but I'll ask it what the weather is.
Totally.
And you should never do that. You should be using a tiny model to ask what the weather is. You should be only using Fable, but most people just are sort of keeping it on the sort of highest end version. I imagine we will soon get to a place where there will be a system that will see what the question is and say, what, this question should go to Fable, but the weather question should go over here.
Got it. All right. Last question. It's already a bestseller. It's won book awards. Are there any books left in the bookstores, and can people still buy it?
Thank you. I believe you can get it on Amazon and at Barnes & Noble and all the stores. You can get it on Kindle. And for those of you who don't like to read, you can listen to it on audio as well. I am the narrator. So
let me close with something for students that are watching this, which is one of the things we teach at American University and at the Kogod School of Business is to have an entrepreneurial mindset. And the two people that have been featured today have that. Andrew was trained as a journalist, but he is an entrepreneur. He's written books. He has created shows. He created a newsletter. He has created all kinds of activities just by being entrepreneurial. And Tom Nides started his career in government, but has gone back and forth at the highest levels of government in finance. He's led nonprofits. And having this entrepreneurial mindset that Tom and Andrew has is a great way to have a very successful career. So Tom Nides, thank you very much. Andrew Ross Sorkin, congratulations on another best-selling book. And thanks to the Blackstone team for hosting a wonderful discussion. Thanks very much.
Thank you, Mr. President.
Thank you, Mr. President.
Okay.